Hey everyone, and welcome back for another deep dive. You might be prepping for that big meeting, catching up on a field or two, or just maybe you're just insatiably curious about this topic.
Yeah.
Well, today we're diving headfirst into inflation. We've got a whole stack of expert commentary,
Oh, yeah.
some really eye-opening economic data visualizations, and even a bit of historical analysis to see if we can
Right.
learn a thing or two from the past.
It's a wild world out there right now.
Yeah, no kidding. It is.
It is.
And we're here to help you cut through all that noise and figure out what really matters. So buckle up, because we're diving deep into three pretty big questions. First, is this recent CPI jump the beginning of like a 1970s-style runaway inflation nightmare?
Oh, scary.
Second, will all those tariffs everyone keeps talking about actually make everything we buy even more expensive?
Good question.
And then finally, are central banks secretly prepping for like a global monetary reset with gold at its core?
Sounds like fun.
Yeah. All right. So first up, let's talk about that CPI report that's got everyone buzzing, right? Prices jumped 0.5% month over month. That was more than anyone expected.
Yeah.
And it really sparked fears of a new inflationary spiral. It feels a bit like 2021 all over again, doesn't it?
It's interesting you say that
Yeah.
because while those CPI numbers might spark some deja vu,
Sure.
it's really important to understand what they actually represent, right? So CPI measures the rate at which prices are increasing, not necessarily that prices themselves are decreasing.
Right. Okay.
So if we take 2008 as an example,
Okay.
even during a recession, the CPI still rose significantly.
So you're saying this could be a similar situation?
Potentially.
Okay.
Yeah.
We saw some pretty big rate cuts from the Fed this year, starting back on September 18th with the Fed funds rate at 5.25%.
Right.
That's eerily similar to what happened back in 2007,
Yep.
right before the whole financial system went haywire.
That's a sharp observation. There are definitely some parallels there.
Right.
But before we,
Hit the panic button.
hit the panic button and assume the money printer's going out of control,
Right.
let's actually look at the data. So the M2 money supply growth, which is just a measure of the total amount of money circulating, right, in the economy, is currently at 38%. That's comparable to levels we saw before the 2008 crisis, not drastically higher,
Okay.
like some people fear.
Okay, so maybe a repeat of the 1970s isn't the most likely scenario.
Right.
But then again, you know what they say, history doesn't repeat, but it often rhymes.
Exactly. And speaking of potential economic rhymes, let's shift gears a little bit
Okay.
and talk about those tariffs and the potential impact on prices.
Yeah.
This is where things get really interesting.
Oh, okay.
And it really directly affects, what you might be paying for everyday goods.
All right, so walk me through this. Let's say I'm at the store, I'm grabbing my usual groceries, a few other essentials. How do these tariffs actually factor into the price I see on the shelf?
Okay, so let's break it down a little.
Yeah. When a tariff is imposed on goods, right, coming from another country, let's say China, it basically increases the cost for importers to bring those goods into the U.S.
Okay.
And those added costs then often get passed down to consumers in the form of higher prices.
So it's basically like a hidden tax that we end up paying at the checkout.
That's one way to look at it.
Okay.
But there's another crucial piece of the puzzle that we really need to consider, and that's the strength of the U.S. dollar.
Okay, this is where I start to get a little lost.
Yeah.
How does the value of the dollar play into all of this?
So think of it like this.
Okay.
A strong dollar basically gives U.S. buyers more purchasing power when it comes to goods from other countries. So even if, a manufacturer in China, let's say, has to pay more because of tariffs,
Okay.
a strong dollar allows them to lower their prices in U.S. dollars and still maintain their profit margins in, their local currency.
Right.
It's a way for them to stay competitive in the U.S. market despite those added costs.
So even if tariffs do push up prices on some things,
Right.
a strong dollar could actually help to kind of balance things out a bit.
Exactly. But it's not a simple equation.
No.
The impact of tariffs and currency fluctuations can vary depending on the specific goods and just kind of the overall economic conditions.
Right. And that makes it even more difficult to predict how these tariffs will ultimately affect the overall cost of living. It's not just about, the price of individual items,
Right.
but also how much money people have to spend overall.
You're hitting on a crucial point there.
Okay.
It's really about that bigger economic picture. and how these factors kind of all interact with each other. So let's maybe take a closer look at that, robbing Peter to pay Paul effect that we mentioned earlier. If consumers are kind of forced to spend more on certain goods because of tariffs, they'll have less money left over to spend on other things.
That makes sense. So even if some prices go up, overall spending might actually go down because people have to prioritize those essential items.
Precisely. It's like a financial balancing act. And if overall spending decreases, well, that could lead to a slowdown in economic activity. That's why it's so important to look at these trends, not in isolation, but as part of a larger interconnected system.
That's a great point. And it makes me wonder, is the market itself buying into this whole runaway inflation narrative?
Yeah.
I mean, we recently saw a dip in the 10-year Treasury yield, which doesn't exactly scream, inflation is out of control, does it?
That's a shrewd observation.
Thanks.
The bond market can often be a leading indicator of what investors are thinking.
Okay.
And this recent dip in yields, it does suggest that the market might not be entirely convinced about the inflation story just yet. But of course, that could change quickly depending on how things unfold.
So it seems like there's a lot of uncertainty out there.
For sure.
And it's not just about inflation. We've got tariffs, currency fluctuations, even the bond market sending mixed signals. It's enough to make your head spin.
It's definitely a complex landscape. But, that's why we're here, to break it down and to help you understand those key forces at play. And speaking of complex forces, let's talk about the consumer.
Okay.
We're seeing some red flags that suggest that financial strain is mounting.
Right.
And that could have major implications for the economy as a whole.
Yeah. Let's unpack that. What are some of the signs that have you concerned about the financial health of the average consumer?
Well, we're seeing a combination of declining consumer sentiment and a surge in borrowing. People are feeling less optimistic about the future, and they're increasingly relying on credit to make ends meet.
That sounds like a recipe for trouble.
It certainly has the potential to be. And the numbers are pretty alarming. We recently saw a record high surge in consumer borrowing, a whopping $40.8 billion. And a significant portion of borrowers are only making minimum payments on their credit cards, which can quickly lead to a debt spiral, especially with interest rates, hovering near historic highs at almost 23%.
Wow, that's a pretty bleak picture. But what's driving this surge in borrowing? Is it simply a matter of people living beyond their means?
Right.
Or is there something more systemic at play?
It's a complex issue with multiple contributing factors. One key driver seems to be the rising cost of living, especially for essentials like, housing, healthcare, and education. Wages haven't kept pace with these rising costs, leaving many people, struggling to make ends meet.
So it's not necessarily about people being irresponsible with their spending, but rather a reflection of the economic realities they're facing.
Exactly. And it's important to note that this trend of rising consumer debt has been building for decades. Take a look at this chart from our source material. It shows how revolving credit, primarily credit card debt, has exploded since the 1970s. It's a long-term trend that's now reaching a pretty critical point.
That chart really puts things into perspective. It's not just a recent blip, but a systemic issue that's been simmering for a long time.
Precisely. And it kind of mirrors a similar trend we're seeing at the national level. Just like individuals are relying on credit to bridge the gap between their income and their expenses, the U.S. government has become increasingly reliant on debt financing to cover its own spending. It's a fascinating parallel that speaks to the larger economic challenges we're facing.
So we've got rising inflation,
the
potential impact of tariffs, and a growing debt burden for both individuals and the government. It paints a pretty concerning picture, doesn't it?
It certainly highlights the need for caution and a deeper understanding of the forces at play. But amidst all this economic uncertainty, there's one asset that keeps popping up in conversations and headlines. Gold.
Gold. The shiny metal that's been a store of value for centuries.
Exactly.
But why is it suddenly back in the spotlight?
Our sources point to some interesting trends. We're seeing record gold purchases, both in Russia and globally.
Wow.
And there's a lot of buzz around something called Basel III, which has major implications for the role of gold in the global monetary system.
Okay, I'm intrigued. But I'll admit, Basel III sounds a bit intimidating. Can you break it down for us in a way that even someone who's not a financial expert can understand?
Absolutely. In simple terms,
Yeah.
Basel III is just a set of international banking regulations
Okay.
that aim to strengthen the global financial system.
Okay.
One of the key changes introduced by Basel III is the reclassification of gold as a Tier 1 asset.
Hold on, Tier 1 asset. What does that even mean?
It means that under Basel III, gold is now considered equivalent to cash in terms of its safety and liquidity. Previously, banks had to discount the value of gold, treating it as a riskier asset. But now they can account for its full value, putting it on par with, cash and U.S. Treasuries.
Wow, that's a pretty big deal.
Yeah.
It basically means that central banks are now viewing gold in a whole new light. But why this sudden shift?
Right.
And why are they seemingly hoarding gold like it's going out of style?
That's where things get really fascinating.
Ooh, okay.
This reclassification has major implications for the paper gold market.
Okay.
Those gold ETFs and futures contracts that many investors use to gain exposure to gold without actually holding the physical metal.
Okay, I'm following so far.
Yeah.
But how does Basel III affect those paper gold markets?
Okay, so Basel III introduces something called the net stable funding ratio rule,
Okay.
which makes it much harder to manipulate gold prices with those paper contracts. Essentially, banks now have to hold more capital reserves against these paper gold holdings,
Right.
making it less attractive for them to engage in the kind of speculative trading that can, artificially inflate or deflate gold prices.
So it sounds like Basel III is designed to make the gold market more transparent and less prone to manipulation.
That's one of the key goals.
Okay.
And this shift has profound implications for central banks,
Ah.
which have historically held significant gold reserves. Remember, gold is considered a safe haven asset,
Yeah.
a hedge against currency instability and devaluation,
Right.
especially during times of global uncertainty.
Right. It's like the ultimate insurance policy against financial chaos.
Exactly. And with all the economic uncertainty swirling around, from inflation fears to potential currency wars, it makes sense that central banks would want to bolster their gold holdings. They're essentially preparing for a potential shift in the global monetary system.
Okay, this is where my mind starts to race with possibilities.
Yeah.
Are you suggesting that we could be heading towards a world where gold plays a much more prominent role in the financial system?
It's certainly a scenario worth considering.
Wow.
As Basel III unfolds and central banks continue to accumulate physical gold, it raises some pretty intriguing questions about the future of money.
This is all incredibly fascinating, but there's one thing I don't quite understand. If this transition to a more gold-backed system is already underway, why is the U.S. lagging behind other nations in implementing Basel III? Full transition isn't expected until 2028.
That's an excellent question.
Yeah.
And it's one that has sparked a lot of debate and speculation.
So what are some of the theories out there? Are they trying to protect the dollar's dominance?
Right.
Or are they scrambling to come up with a plan B?
Those are some of the key questions we'll be exploring as we continue our deep dive. It seems there's a lot more to this gold story than meets the eye.
It's like we're piecing together a financial thriller here, with central banks making these big moves in the gold market. It's both fascinating and a bit unsettling.
It's definitely a story worth paying attention to, especially considering what we were just discussing, about consumer debt and the possibility of an economic slowdown. It makes you wonder if those events are somehow connected.
You're right, that connection is crucial.
Mm-hmm.
We were just talking about how consumer debt is, skyrocketing. Is this just a case of people overspending, or are there deeper economic forces at play that are pushing individuals to rely more on credit?
I think it's more nuanced than simply blaming overspending. Think about the economic pressures many people are facing. The cost of living has been steadily rising, particularly for essentials like housing, healthcare, and education. Yet wages haven't kept pace with these increases. This leaves many individuals and families in a really precarious position, forced to rely on credit to bridge the gap between their income and their expenses. It's a bit like, running on a financial treadmill. You're working hard, but it feels like you're not making any real progress.
So instead of pointing fingers at individual spending habits, it's important to consider that broader economic context that's contributing to this rising debt burden. It's a systemic issue, not just a personal failing.
Exactly. And it's interesting to note that this trend of increasing reliance on credit is happening in parallel with the U.S. government's own growing debt. Both individuals and the nation as a whole seem to be caught in a cycle of spending beyond their means,
Yeah.
relying on borrowed money to keep things afloat.
It seems like we're in a bit of a financial house of cards with both individual and national debt piling up. So what does this all mean for the average listener? How should we be thinking about our own finances amidst all this uncertainty?
Well, I think this is a wake-up call. It's a time to be mindful of our own financial habits and to prepare for potential economic headwinds. We can't just sit back and assume that things will always go up. It's also a time to question the narratives we're being fed,
Right.
to develop our own critical thinking skills and not blindly accept the status quo. After all, we're the ones who ultimately bear the consequences of these economic trends.
I love that. Question everything, especially when it comes to something as crucial as our finances. And speaking of questioning the status quo, let's circle back to this whole gold situation. It's clear that central banks are making some significant moves. But what does that mean for individual investors? Should we all be rushing out to buy gold bars and bury them in our backyards?
Hold on, let's not get ahead of ourselves.
Yeah.
Historically, gold has served as a hedge against inflation and currency devaluation. It's a tangible asset that holds its value over time, unlike fiat currencies that can be printed at will by governments. This is why it's often seen as a safe haven asset, something people turn to in times of economic turmoil.
So are you saying that gold could be the key to navigating this potential monetary reset we've been discussing? The
Yeah.
one where central banks seem to be shifting away from the dollar and towards something more, well, golden.
It's certainly worth considering. As Basel III unfolds and central banks continue to accumulate physical gold, it raises some intriguing questions about the future of the global monetary system. We could be witnessing a transition away from the dollar-dominated system that's been in place for decades.
Okay, you've officially piqued my curiosity. What are the experts saying about this potential shift? Is a return to the gold standard on the table?
Not necessarily a return to the gold standard in its traditional form,
Okay.
but perhaps a new system where gold plays a more prominent role. A system that prioritizes stability and sustainability
Right.
over reckless growth and speculation. Many analysts believe that the current system, based on endless consumer spending and debt accumulation, is reaching its limits. They see gold as a potential alternative, a more stable and secure foundation for a new financial order.
That's a pretty bold prediction. But if this is the direction we're heading in, how can the average person prepare? Should we all be converting our savings into gold bars?
It's not about making drastic moves or putting all your eggs in one basket.
Okay.
It's about understanding the fundamentals of sound money, diversifying your portfolio, and considering the long-term implications of these global trends. This could mean exploring different asset classes, including precious metals like gold, as a way to hedge against potential risks in the traditional financial system.
This is all incredibly insightful. It feels like we need to dedicate a whole separate episode to this gold conversation.
Oh, for sure.
There's so much to unpack.
I agree. It's a topic that deserves a deep dive of its own.
Yeah.
But for now, let's maybe bring it back to the present moment.
Oh,
We've covered a lot of ground today, from inflation and tariffs
uh-huh.
to consumer debt and the potential for a monetary reset.
Yeah.
What are some key takeaways for our listeners as they navigate this complex economic landscape?
Yeah, let's try and synthesize all this information into some actionable insights. What are the key things our listeners should be thinking about as they manage their own finances?
Well, I think the biggest takeaway is that we're living in a time of unprecedented change and uncertainty. The economic landscape is shifting, and the old rules no longer apply. It's more important than ever to be informed, to question the narratives we're being fed, and to take control of our own financial destinies. Don't just blindly follow the crowd or rely on outdated advice.
I love that. Knowledge is power. And this deep dive has certainly empowered me to think critically and make more informed decisions about my own financial future. It's about being proactive and taking ownership of our financial well-being rather than just hoping for the best.
Exactly. We want to equip you with the tools and insights you need to navigate these complex times and thrive regardless of what the future holds.
It feels like we've uncovered several layers of the financial onion today, and with each layer, we're getting a clearer picture of the challenges and opportunities that lie ahead.
Yeah, it's like we're assembling a financial puzzle one piece at a time. We've examined inflation, tariffs, consumer debt, and the potential for a monetary reset. Now, the key is to connect those pieces and see what picture emerges.
Exactly. And for our listeners who are, trying to make sense of their own financial situations, what's the most important message they should take away from all of this?
I think the key is to be proactive. Don't just sit back and wait for things to happen. Take the time to understand these trends and consider their potential impact on your own financial strategy. This isn't about panicking or making rash decisions, but rather about being informed and prepared.
For example, if those central banks are right about gold's future role in the monetary system, what adjustments might people need to make to their portfolios?
That's the million-dollar question, isn't it? There's no one-size-fits-all answer, and it ultimately depends on, individual circumstances, risk tolerance, and financial goals. But asking these questions and exploring different possibilities is crucial.
So it's not necessarily about going all in on gold, but rather about understanding its potential role in a changing financial landscape and then deciding how that fits into your own investment strategy.
Precisely. It's about diversification, risk management, and thinking long term. And remember, we're not financial advisors, so it's always best to consult with a professional who can provide personalized guidance.
Absolutely. We're here to provide information and insights, but ultimately each individual needs to take ownership of their own financial journey.
That's right. It's about empowerment through knowledge. The more you understand, the better equipped you'll be to make sound financial decisions that align with your goals and values.
Well said. And that's what we've aimed to do today, give you a deeper understanding of these complex economic forces so you can navigate them with confidence.
We've only scratched the surface of these topics, and there's always more to learn. But hopefully this deep dive has, sparked your curiosity and inspired you to keep exploring.
Exactly. We encourage you to continue researching, asking questions, and challenging conventional wisdom. After all, the world of finance and economics is constantly evolving, and it's up to each of us to stay informed and adapt to the changing landscape.
And who knows, maybe you'll uncover some insights that even we missed.
That's the beauty of learning. It's an ongoing journey of discovery.
Well, on that note, I think it's time to wrap up this deep dive.
All right. Thanks for joining us, everyone. And remember, stay curious, keep learning, and take control of your financial future.